Investing in startups can feel like stepping into a goldmine. Many people dream of finding the next big thing and making a fortune. But here's the shocking truth: 90% of startups fail. Yes, you read that right. While we hear stories of huge successes, the reality is that most startups don't make it. This means the chances of losing your investment are much higher than you might think. So, why do so many investors dive in? Often, it's the excitement and promise of big returns that cloud judgment. Many get swept up by flashy pitches and charismatic founders. But behind the glamour lies a world of hidden risks that can turn your investment into a disaster. In this video, we'll explore the unseen dangers of investing in startups. We'll reveal strategies to protect your money from common traps, like the illusion of explosive growth and the dangers of overhyped founders. You'll learn why understanding product-market fit is crucial and how to negotiate your way to safer investments. Get ready to uncover the truths that many investors overlook. By the end, you'll be better equipped to navigate the risky waters of startup investing. Let's dive in and arm yourself with the knowledge to make smarter decisions. Chapter 1. The illusion of explosive growth. Startups love to paint a picture of explosive growth. Every pitch deck you see will likely have those famous hockey stick charts, showing exponential revenue increases. But here's the truth: most startups don't grow as fast as they claim. In fact, according to the Startup Genome Project, 90% of startups fail, and a big reason is overestimating growth. This overconfidence bias is a real trap. Founders can get carried away by the excitement of their own ideas, and they often predict market growth based on best-case scenarios. As an investor, it's crucial to see through this optimism. Instead of taking their word for it, ask tough questions. Dig into their customer acquisition costs, CAC, and how fast they're burning cash. Here's a strategy to help. Focus on realistic, sustainable growth metrics. Look for companies with solid unit economics. Are they profitable on a per-customer basis? And more importantly, is their growth realistic when compared to industry standards? Remember, slow and steady often wins the race. Charlie Munger, Warren Buffett's longtime business partner, once said, "It's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent." Chapter 2. The burn rate trap. When scaling too fast backfires. Rapid scaling is the dream of every startup founder. But here's the dirty secret: scaling too fast can lead to disaster. A high burn rate, how fast a startup is spending its cash, is a flashing red light that many investors overlook. According to data from CB Insights, 29% of startups fail because they run out of cash. That's why understanding a startup's burn rate is key. A high burn rate might mean the startup is scaling aggressively, hiring quickly, launching new markets, or spending big on marketing. But if that growth isn't supported by actual revenue, the company can hit a wall fast. It's not just about how fast you grow, it's about whether you're growing efficiently. Your strategy here? Look for a balance between growth and sustainability. A company burning through its cash without clear signs of profitability should raise alarms. Ask the founders how they plan to extend their runway, the amount of time they can keep operating before running out of cash. If they're relying heavily on future rounds of funding, you might be in for a rough ride. A company should have clear plans to reach profitability, not just endless fundraising. Interesting fact: according to a Harvard Business Review study, only 10% of companies that scale fast actually survive. That's a huge risk if you're just chasing startups that promise quick growth. Chapter 3. Unseen dilution. Your ownership is shrinking. You might think that getting in early means a bigger slice of the pie. But in the startup world, that slice can shrink fast due to dilution. Every time a company raises money, it issues more shares, and your ownership percentage gets smaller. This is called dilution, and it's one of the most overlooked risks for investors. For example, imagine you own 10% of a startup. The company raises another round of funding, but instead of issuing 10% more shares, they issue 50% more shares. Suddenly, your ownership drops to 6.67%. While this might not sound dramatic, dilution over several funding rounds can drastically reduce your share of the profits when it comes time to sell or go public. The strategy to protect yourself? Negotiate anti-dilution clauses. When investing in early-stage companies, ask for protection against heavy dilution. Many sophisticated investors negotiate clauses that adjust their ownership percentage if future funding rounds issue new shares at a lower valuation. This way, your ownership isn't drastically reduced by subsequent rounds. A famous quote from investor Fred Wilson says, "Sometimes getting in early is less important than negotiating for protection later." So, make sure you're thinking long-term about how future funding rounds will impact your stake. Another key point? Keep an eye on how the founders are handling their own dilution. If they're giving up too much equity early, they might not have enough skin in the game to stay motivated. Founders who get diluted too quickly might lose interest or get forced out. As an investor, you want to ensure the founders remain deeply committed. If you're finding this information valuable, don't forget to subscribe to stay updated on more insights and strategies for smarter investing. Chapter 4. Hype versus reality. The cult of the founder. There's something magnetic about a charismatic founder. Many investors get swept up in a leader's vision, charisma, or storytelling ability. But here's the problem: a great storyteller doesn't always build a great company. It's easy to get blinded by the hype surrounding a rock star founder, but that can lead to trouble if the company doesn't have a solid business behind the hype. In fact, according to the Harvard Business Review, 70% of startups fail because of leadership issues. The founder's vision might be strong, but if they can't execute, your investment is at risk. Just think of Elizabeth Holmes, the founder of Theranos. She created massive hype around her blood testing technology, but the company collapsed once the realities of their product became clear. Even experienced investors got caught up in her charisma. So, what's the strategy here? Focus on substance over storytelling. When evaluating a startup, don't just pay attention to the founder's vision. Look at the actual team they've built, their experience, and how well they've executed so far. Ask hard questions. Do they have the skills to handle operational challenges? Can they pivot if things go wrong? A useful tip: watch for founders who've successfully built something before. While not every founder needs to be a serial entrepreneur, having experience in launching or growing a business can be a huge advantage. Reid Hoffman, co-founder of LinkedIn, says it best: no matter how brilliant your mind or strategy, if you're playing a solo game, you'll always lose out to a team. So, dig deep into the team's collective talent. Chapter 5. The overlooked exit strategy risk. Most people talk about how to get into a startup investment, but few think about how to get out. The truth is, exiting a startup investment is far more complicated than entering. Whether it's through an acquisition, a buyout, or an IPO, exit strategies are unpredictable. And if a startup doesn't have a clear exit strategy, you might be left holding an illiquid investment for much longer than you'd like. Data from Crunchbase shows that fewer than 1% of startups actually go public. While we hear about blockbuster IPOs like Airbnb and Uber, the vast majority of startups either get acquired, often at lower than expected valuations, or fail to reach a successful exit altogether. Without a clear plan for how you'll get your money back, even a promising investment can turn into a dead end. Here's the strategy to protect yourself: always evaluate the exit options before you invest. What's the founder's vision for the endgame? Are they aiming for a public listing, or is acquisition their likely path? If the company is relying solely on IPO dreams, consider that a red flag. Even companies with solid business models can struggle to find buyers or investors at a high enough valuation. Another useful tool? Negotiate for liquidation preferences. This means that if the company is sold, you'll get your money back before common shareholders, including the founders, get paid. This can safeguard your returns, especially in less than ideal exits. Jason Calacanis, an early Uber investor, says, "The only bad exit is no exit," meaning you want to make sure there's a clear path to cashing out. If you enjoyed this video and found the information helpful, please subscribe for more insights on making informed investment decisions.